Most people do not lose the investing game because they chose the wrong stock. They lose because they built the wrong machine. That is the first thing I want you to understand. They spend years chasing the perfect portfolio. One fund this month, a different fund next month, a new opinion every quarter. One expert says international stocks are overdue. Another says bonds are back. Another says technology is finished. Another says technology is the only thing that matters. And after enough years of this, they end up with a collection of positions they can barely explain, a level of anxiety they never planned for, and a retirement account that somehow still feels too small for the life they were promised. That is not a market failure, that is a structure failure, because wealth is not built by complexity, it is built by clarity. It is built by owning a machine where every part has a job, every job matters, and the whole system keeps working even when your mood does not. That is why I like this idea so much. Not because it is new, because it is simple enough to survive your emotions. And simplicity that survives emotion is worth a fortune. The old bogleheads were right about one thing that still matters more than almost everything else. Most people do not need more choices. They need fewer mistakes. That was the real genius. Own broad markets. Keep costs low. Do not guess the future every week. Let time do the heavy lifting. That framework built a lot of quiet wealth, but the world keeps moving. And if you want to build something stronger now, you have to ask a better question. Not whether the old structure was wrong, whether the old tools are still the best tools for the jobs that matter. Now, that is where this portfolio gets interesting, because the core idea is not 3 funds. The core idea is 3 jobs. 1 anchor, 1 growth engine, 1 income layer. That is the whole machine. And if you build it properly, the machine starts doing what most investors never manage to do for themselves. It stays understandable. Now, I want to begin with something almost nobody says clearly enough. The average family retires with far less than it thinks it will need. The source document cites about $334,000 as the average American family's retirement savings, and at a 4% withdrawal rate that is only about $13,000 a year. Faithfully cite Turn 44 File 0 Fay that is not retirement security. That is a warning. You can call that a nest egg if you want. I call it fragile, because a portfolio that small has no room for illusion, no room for a bad sequence of returns, no room for inflation staying rude, no room for one medical event, one housing repair, one long life, one market panic, one bad decision at the wrong moment. And that is why I keep coming back to the same principle. The goal is not to sound sophisticated. The goal is to build a portfolio that can carry real life. This is where most people make the same mistake again and again. They treat investing like a personality test, aggressive, conservative growth. Income as if choosing a style is the same thing as building a machine. It is not. A machine asks a different question. What function does this piece perform? That is how adults build wealth, not with labels, with roles. So let me show you the first role, the anchor. Every serious portfolio needs something at the center that you can trust when the market is being stupid. Not the fastest thing, not the sexiest thing, the thing that gives the rest of the structure legitimacy. That is why I like VTI, the Vanguard Total Stock Market ETF. The source document describes it simply and correctly. It owns the broad U.S. stock market, more than 3,500 publicly traded companies, which means that when you buy it, you are not betting on one company or even one industry. You are betting on the broad productive engine of American business. Turn 44 File 0 Fay that matters. Because most people are terrible at picking winners in advance. They say they want concentration. What they usually mean is they want to feel smart. The market has a way of humiliating that urge. VTI removes the need to be a hero. It lets you own everything. Technology. When technology is winning. Healthcare, when healthcare is carrying the load. Industrials, when the real economy has a pulse. Consumer businesses, when everyday spending matters. The weak get smaller. The strong rise, the market adapts inside the fund for you. That is one of the most beautiful mechanisms ordinary investors have ever been given. And the source transcript gives the kind of numbers people need to respect. It says VTI currently yields about 1.13%. Its dividends have grown at roughly 6.16% annually over the past decade, and its annual share price growth over that period averaged around 12.45%. Faithful site, Fayturn 44 file 05. I want to pause on that. 12+% annual appreciation over a decade, plus dividends in something this broad. That is not exciting enough for gamblers. Good. That is exactly why it works. The anchor should not feel like a race car, it should feel like a foundation. And the source document projects that $10,000 invested in VTI and left alone with dividends reinvested could grow to roughly $387,355 over 30 years. Fay file a site, Fayturn 44 file 0 Fay. Whether the exact future number arrives like that or not is not the point. The point is what it teaches. A broad anchor does more in the background than most people can do in the foreground. That is the whole lesson. Now, if the anchor is the first job, the second job is growth, real growth, not a fantasy stock, not a shaky promise, a concentrated engine of the companies shaping how the world actually operates. That is why the source transcript upgrades the old international slot into QQQ. It argues that today's largest U.S. companies already have global reach. So you are not buying a provincial America story. You are buying dominant businesses with worldwide revenue streams and technological leadership. Faithful site, Fayturn 44 file 0 Fay. I think that is exactly the right frame. People still talk about international diversification like the world has not changed. But if Apple sells everywhere, Microsoft powers enterprises everywhere, NVIDIA's chips sit inside infrastructure everywhere, then some of the old geographic labels matter less than the quality and dominance of the businesses themselves. That is what QQ captures. It is not the whole market. It is the sharper edge of the market, the NASDAQ. 100, a more concentrated bet on technology, software, semiconductors, digital infrastructure, and the higher growth side of the productive economy. Now, let me be honest. This is where weaker investors get themselves in trouble. They hear growth and they forget volatility. That is childish. Every growth engine has a price. The price is movement. QQQ moves harder on the way up and can move harder on the way down. The source document says exactly that and notes that this fund can pull back more sharply than VTI Fayfile site, Fayturn 44 file 0 Fay good. That is the bargain, higher upside, higher emotional difficulty. That is why it belongs in the machine, only because the anchor exists. First, the anchor keeps the growth engine from becoming the whole story, and the growth engine keeps the anchor from becoming too sleepy. That is how the machine stays balanced. The source transcript says QQQ yields around 0.46%, that its dividend growth over the last decade averaged roughly 9.73%, and that its annual price appreciation averaged about 19%. It also projects that $10,000 compounded there for 30 years could approach about $1.92 million. Faithful site, Fayturn 44 file 0 Fay again. I do not care whether the exact number lands on the calendar exactly like a spreadsheet fantasy. I care about what the structure teaches. If you own a real growth engine long enough, it can do the heavy lifting that average retirement math never touches. That is why the middle of this machine matters so much. The anchor protects. The growth engine changes the outcome. But there is still one problem. Growth does not pay your bills while you are waiting for it. That is where most people get restless. They own growth. The market pulls back. The dividend is tiny. The future looks good on paper. The present feels useless. That is why the third layer matters: income. Real cash flow. A portfolio needs something that pays you while time is doing the rest of the work. The old bogleheads used bonds for this job. I understand why bonds smooth things out. Bonds pay interest. Bonds gave the portfolio a stabilizer. But the source transcript makes the case that in the current environment, traditional bonds are weaker tools than they used to be, especially when inflation can eat through fixed income more aggressively than older models assumed. Faithfully cite Fayturn 44 file 0 Fay. That is exactly the point. A bond can pay you and still leave you poorer in real terms if inflation is ruder than the coupon. So instead of a bond fund, this portfolio uses SCHD, and I think that is the smartest part of the whole design. SCHD is not just a dividend fund. It is a quality filter disguised as an income layer. The source document explains that SCHD screens for companies with strong balance sheets, consistent dividend histories, and the financial strength to keep raising payouts over time. Fe file a site, Fe turn 44 file 0 Fe that matters, because in retirement, or even before retirement, what you really want is not merely a check. You want a check that can grow. That is the difference between dead income and living income. A bond pays a fixed amount. A good dividend fund gives you an income stream attached to businesses that can adapt, raise prices, grow payouts, and let your income rise with time instead of staying frozen while the world gets more expensive. That is a much better machine. The source transcript says SCHD yields about 3.39%, that its dividend growth over the last decade averaged about 10.61%, and that its price appreciation averaged around 8.92%. It projects that $10,000 invested there and left to compound could reach about $422,014 over 30 years. While generating over $20,000 a year in dividend income by then, Fe file site Fe turn 44 file 0 Fe. That is beautiful. Not because it is fast, because it is useful. This is the piece that pays you while you wait. This is the piece that turns ownership into a paycheck, like experience, without forcing you to sell down the machine. And now you can see the architecture clearly. VTI is the anchor, QQ is the growth engine, SHD is the income layer, 3 jobs, 3 very different roles, 1 portfolio with actual internal logic. That is why I like this so much. It is not clever for cleverness' sake. It is elegant because the roles do not fight each other. They complement. Now let us talk about what happens when you put them together. The source transcript proposes an equal weight structure, roughly 1/3 in each ETF. And from those assumptions, it calculates a combined dividend yield of about 1.66%, dividend growth of around 8.83%, an annual share price appreciation of around 13.46%. Fe file site Fe turn 44 file 0 Fe. I like equal weighting here because it forces respect for all 3 jobs. Too much anchor and you get too safe too early, too much growth and you become emotionally hostage to volatility, too much income, and you risk becoming less dynamic than your future will require. Equal weight gives you clarity. And the source transcript projects that $10,000 split across the 3 and left alone could grow to around $560,970 over 30 years. It also says that by then the portfolio would be generating roughly $2,868 a year in dividends. Fe file site Fe turn 44 file 0 Fe. That is not a fantasy outcome for nothing. That is the reward for design. But what really interests me is the other scenario in the transcript, the $10 a-day version, because this is where most ordinary people either finally wake up or stay asleep forever. The source material says that if you simply invested $10 a day into this 3 ETF machine, then after 10 years, the projection is about $73,084. After 20 years, around $349,627, and after 30 years, about $1,364,774, with more than $5,000 a year in dividends. By that point, Fe file site Fe turn 44 file 0 Fe read, that's slowly $10 a day. That is not heroic. That is not rich. Person money. That is disciplined. Person money. This is why I always say the greatest wealth gap in the world is not between people who know and people who do not know. It is between people who repeat and people who only admire repetition from a distance. $10 a day is not impressive today. That is the point. Nothing powerful looks powerful at the beginning. The first dividend feels tiny. The first year feels slow. The first 5 years may feel almost insulting if you are addicted to fast results. Then the math changes. Then the machine takes over. Then the same small habit begins doing work your willpower alone could never do. That is how wealth actually gets built, not with a dramatic entrance, with repetition so boring. Most people quit before it becomes beautiful. Now, I want to say something about the claims in the transcript because this matters intellectually. Future returns are never guaranteed. No one gets to promise you that VTI will keep compounding at exactly one historical rate, or that QQQ will keep doing 19% forever, or that SAG will always behave in the same way it did in the last decade. Markets do not sign contracts with spreadsheets, but that does not weaken the core insight. The exact number can vary. The architecture still matters. And the architecture is the real value here. That is what people miss when they argue about forecasts. They fight over the final decimal and ignore the machine. The machine is what matters. A portfolio with a broad anchor, a concentrated growth engine, and a quality income layer is simply better designed than the messy pile of random funds most people accumulate by accident. That is the whole lesson. Now let me tell you what most people do instead. They overcomplicate. They add more funds because more funds make them feel active. They double up on the same exposure because more tickers make them feel diversified. They jump in and out because movement feels like intelligence. They buy broad funds and then sabotage them with narrow guesses they cannot emotionally manage. Or they do the opposite. They build a beautiful structure and then ruin it by abandoning it at the first sign of pain. That is why the source transcript S3 rules matter so much. Pick one ETF from each category. Know your goal, stay consistent. Fay file site, Fay turn 44 file 0 Fay. Those three rules sound simple because they are. That is exactly why they work. The first rule prevents clutter. The second rule prevents mismatch. The third rule prevents self-destruction. That is a serious framework. Now, let me make this brutally practical. If you are young, your real enemy is not volatility. It is delay. You can survive drawdowns. You may not survive 10 more years of telling yourself you will start when you have more money, more clarity, a better job, a calmer market, or a nicer chart. The market never sends a handwritten invitation. Adults begin with what they have. If you are older, then the machine still matters, but the waiting may matter more. The source transcript itself says you can tilt heavier toward QQ if growth matters most, and heavier toward SCHD if income matters more. Now, Fay file site, Fay turn 44 file 0 Fay, that is correct. The roles stay the same. The emphasis can change. And this is where the portfolio stops being a theory and becomes a life tool. You can adapt it to age, you can adapt it to income, you can adapt it to temperament. But the machine remains understandable. That is the great gift. Not only possible returns, usable clarity. Now, I want to say something that may sound harsh. If you cannot explain why every fund in your portfolio exists, you do not have a portfolio, you have a collection. Collections are for hobbies, portfolios are for outcomes. The man with 12 overlapping ETFs and no idea which one is supposed to carry growth, which one is supposed to protect him, and which one is supposed to pay him, is not diversified. He is confused, and confusion is expensive. That is why this three-part structure is so powerful. You can explain it in one breath. This part owns the broad market. This part compounds harder. This part pays me while I wait. That is it. That is a real machine. Simple enough to remember, strong enough to trust. And because it is simple, it becomes much easier to keep doing the one thing that matters more than almost anything else. Feed it month after month, year after year. That is what compounding asks of you, not brilliance feeding. And the more I look at markets, money, and human behavior, the more convinced I become that simplicity is not the opposite of sophistication. It is often the highest form of it. The sophisticated person does not always own the most complex structure. He often owns the structure that survives him, the one that keeps working when he is tired, busy, uncertain, distracted, or emotionally weak. That is this portfolio. That's real strength. It can survive your moods. And if a portfolio can survive your moods, it already has a tremendous advantage over almost everything else ordinary people do with money. So if I had to reduce this whole idea to one sentence, it would be this. You do not need 50 positions to get rich. You need one portfolio where every piece knows its job and you know yours. The portfolio compounds, you stay consistent. That is the partnership. And if you can do that long enough, $10 a day stops looking like a coffee budget and starts looking like the first quiet brick in the wall. Most people will spend the rest of their lives wishing they had started building sooner